Yes, Sarah. Our February read on the Conference Board consumer confidence expected to be in the vicinity of 108 comes in lower, 102.9, 102.9. That's the lowest since November of last year. But the present situation, a different story. It is better than expected and higher sequentially. At 152.8, it is the best level since April of last year. And finally, what lies ahead are expectations, 69.7. 69.7, that's less than expected, sequentially lower than a slightly revised 76. And 69.7, well, you have to go back a ways to find that number. 69.7 is the lowest since July of last year. And very quickly, Richmond Fed Manufacturing Index for February also a miss at minus 16. Minus 16, that is the worst level since May of 2020. We see interest rates are ticking down a bit. We've still have not been able to cross over in that 4% zone. All Treasury rates are higher on the session, and we continue, of course, to monitor the upward pressure we had earlier in the session from European rates as we see that the ECB terminal rate is now approaching 4%. Carl, back to you.
All right, Rick, thank you so much. Rick Santelli. Consumer confidence, of course, just one piece of the macro picture today that's in focus for investors. Goldman Sachs' David Solomon on Squawk today talked about inflation and it perhaps being stickier. Take a listen.
I think the general consensus is inflation is going to be stickier. When I talk to CEOs, stickier and harder to move, from where it is now, down to 3%, let's say, let alone 2%. Right. I think we're in a place where there's a little bit more optimism about muddling through, but I think inflation is going to be sticky and hard. And, I think anyone running a business has to be prepared for kind of a bumpy 12 to 18 to 24 months.
Although, given the data today, whether that's Case-Shiller with the deceleration in home prices, you saw Chicago PMI, you saw Conference Board just now, market's going to welcome numbers that are even directionally soft, Sarah.
I think what the consumer confidence number is important because it was our first read for February, and it was weaker, which is a good thing. I mean, it's not a good thing for consumers to have less confidence, obviously, but the market's been really rattled by all this good economic data that we've seen. That has been the story of the market in February. Weaker market digesting strong economic data and a higher outlook for the Federal Reserve Fed funds rate. I mean, we're now at 5.4% on the terminal rate. That's what the market is pricing in. A month ago, David, it was 5%. So that's the adjustment. It could have been worse, frankly, given how sensitive last year the market was to
Fed rate expectations. Could still be worse, couldn't it? Doesn't mean we're done yet.
No, it doesn't.
Well, B of A today suggests 6. The first one to really put a 6 in there.
Yeah, Wilf said 6 too. Yeah. And 4% now priced in, as Rick said, for the ECB terminal rate. Spain and France both put out inflation numbers. They saw some pretty big monthly jumps in inflation. So the inflation story is really going to determine, I think, what happens this year. And at the same time, the economy. And we're still trying to figure out what's going on there.
Yeah, JP Morgan had a great chart last night. Core goods inflation in this country, 3-month annualized, down 1.5. I mean, we've done some pretty good wood chopping here, but the rest of the world, it's still running 6 to 8. So you can imagine the 50 basis point discussion is going to get maybe a little more tender in countries or areas like Europe than the U.S.
I think the other question, guys, is what to do, with this market, because year to date, we're still looking at some gains for the S&P 500 and the NASDAQ. Can the market stomach higher rates for longer, given the fact that we still could be closer to the end than the beginning, especially if the Fed continues on the 25 basis point hike path, which is most of the market expectations at this point. A lot of these Wall Street strategists have been very bearish. We talked about this yesterday. Morgan Stanley, JP Morgan said the risk reward is not good. And if you look at some of the action and the positioning, traders are getting more bearish. I just wanted to pull up, from Citigroup, a lot of outflows from ETFs, and more pessimistic positioning. Citigroup strategists say markedly